السلام عليكم ورحمة الله وبركاته. يسعدنا أن نرحب بكم في هذه الجلسة الخاصة لتبادل المعرفة الذي يستضيفها بنك الدوحة من أجل تسليط الضوء على قطر والتجارة الدولية. كما نود أن نشكر رئيس وأعضاء مجلس إدارة بنك الدوحة والإدارة التنفيذية على استضافتهم وتنظيمهم لهذه الندوة. Good evening, ladies and gentlemen, and welcome to the special knowledge sharing session being hosted by Doha Bank that highlights synergies and partnership opportunities for Qatar and international trade. I would like to thank His Excellency the Chairman, Board of Directors, and the Doha Bank Executive Management Team for hosting and organizing this seminar. فلنلقي الضوء على المتحدث الأول لدينا السيد جودي جلان، وهو شريك في تميمي ومشاركه، ولديه خبرة واسعة في مجال البنوك والتمويل، حيث عمل في العديد من البنوك والشركات التمويلية والمؤسسات وإقراض الشركات وغيرها من العملاء التجاريين. ويلعب جودي دورا بارزا في أنشطة الصيرفة الإسلامية وتمويل المشاريع والشركات. Our first speaker is Mr. Judy War, is a partner at Tamimi & Company and has extensive experiences in the areas of banking and finance, have acted for registered banks, financial companies, corporate borrowers, and a range of other commercial and corporate clients. He has also a leading role in the firm Islamic banking practice and its project financial practice. Please welcome with me Mr. Judy. متحدثنا الثاني هو السيد مهان بوليرتشي، وهو مدير إدارة المخاطر والمعلومات والمتطلبات في يولر هيرمز بمنطقة دول مجلس التعاون في دبي، وهو مسؤوليته في منطقتي الخليج والشرق الأوسط. أمضى مهان 13 عاما في يولر هيرمز، وبدأ مسيرته المهنية مديرا تنفيذيا للائتمان الصادرات في هامبورغ بألمانيا. خلال هذه الفترة تولت مؤسسته مخاطر الائتمانية وإدارة الأعمال والعملاء متعددي الجنسيات ليولر هيرمز، وتمتلك شركة يولر هيرمز شبكة ائتمانية معلوماتية متميزة تتيح لها تعليل الاستقرار المالي لأكثر من 40 مليون شركة ومؤسسة حول العالم. Our second speaker is Mr. Mahan Bullard, is the Director of Risk Management, Information and Claims at Euler Hermes, responsible for the GCC and Middle East region. Mahan has been at the Euler Hermes for the past 13 years and has been his career as the Senior Expert Credit Manager in Hamburg, Germany. He has been responsible for underwriting credit risk and managing Euler Hermes' multinational business client. His company, Euler Hermes, has a credit intelligence network that enables it to analyze the financial stability of 40 million businesses across the globe. Please welcome with me Mr. Mahan. متحدثنا التالي هو السيد فيليب ليميرز، وهو رئيس فريق السياسة العامة في شركة PwC الألمانية. يقوم السيد فيليب بتقديم الاستشارات للحكومات على المستوى المحلي والدولي حول مسائل تشجيع الاقتصاد وتطوير المؤسسات الصغيرة والمتوسطة وتصميم البرامج الترويجية العامة، بفضل خبرته في مجال الائتمان الصادرات والتأمين ضد المخاطر السياسية، والتي اكتسبها من خلال مشاركته في العمليات والوكالية الألمانية لمخاطر الصادرات. يساعد فيليب العملاء في دول مجلس التعاون الخليجي وأوروبا فيما يتعلق باستراتيجيات ECA. Our next speaker is Mr. Philippe Lemmers, is the head of public policy team at the PwC Germany. In his role, he advises government on the local and international level of matters of economic promotions, SME development, and the design and implementation of public promotion programs, with his experience in export credit and political risk insurance, gained in the German export credit and investments insurance agencies operations. He specifically helped clients in the GCC region and Europe with ECA strategies. Please welcome Mr. Philip. يشرفنا أيضا كمتحدث السيد روهان ويسكوت، وهو المدير التنفيذي المسؤول عن حلول تجارة الطاقة للأعمال داخل تابة العملات السلع في بنك ماكوري. شارك روهان في العديد من أعمال بنك ماكوري وخاصة في مجال السلع. يعمل روهان في سنغافورة منذ عام 2010. We have also with us Mr. Rohan Westcott, is a managing director responsible for energy trade solutions of the fixed income, currencies, and committee business at Macquarie Bank. He has been involved in various aspects of my career as committed to business. Rohan has been based in Singapore since 2010. Please welcome with me Mr. Rohan. السيدة ناتالي بويد شريك مالي في K&L Gates، وهي متخصصة بشكل أساسي في التمويل المركب والتوريق في أسواق الدين ورأس المال وتنظيم الخدمات المالية بمنطقة دول مجلس التعاون الخليجي. تمتلك ناتالي أكثر من 20 عاما من الخبرة تقديم الاستشارات لكبرى الشركات والمؤسسات المالية والدولية والإقليمية فيما يتعلق بالتعامل المحلي والعابر للحدود التي تضم إعداد الهياكل وعمليات إصدار السندات التقليدية والإسلامية. Up next is Ms. Natalie Boyd, a financial partner at K&L Gates. She is primarily focused on structured finance, security status, debt capital, marketing, and GCC-wide finance services relations. She has over 20 years of experiences advising leading international and regional corporate and finance institutions on domestic and cross-border transactions, including restructuring and both conventional and Islamic bonds. Please welcome with me Ms. Natasha. يسرني أن أقدم لكم الدكتور سيتا رمانا رئيس التنفيذي لمجموعة بنك الدوحة ليوضح لنا هذه الندوة. يعتبر الدكتور سيتا رمانا الرئيس التنفيذي لمجموعة بنك الدوحة من الشخصيات البارزة في القطاع المصرفي على مستوى منطقة الشرق الأوسط، وهو خبير اقتصادي بارز حقق نجاحات كبيرة لإسهامات الملموسة في قطاع الأعمال المصرفية، التجارية، الاستثمار، الاقتصاد، البيئة، المسؤولية الاجتماعية والأعمال الخيرية. منح الدكتور سيتا رمان العديد من الدرجات العلمية من قبل جامعات رائدة في العالم، حيث حصل على درجة الدكتوراه في الحوكمة العالمية في عام 2013 والدكتوراه الفخرية من الجامعة الأوروبية، وهو محاسب قانوني بارز وحاز على ميدالية ذهبية عند تخرجه من كلية التجارة وحصل على درجة البكالوريوس. Our moderator for tonight is Dr. R. Sitaraman, Group Chief Executive Officer of Doha Bank, is a prominent personnel in the banking industry throughout the Middle East, an economist expert who has achieved remarkable success for his contributions to banking, trade, investment, economy, environment, social responsibility, and charity. His recent and multiple doctors from leading universities from the world, including a PhD in global governance in 2013, and honorary doctors from the European University. He's a chartered accountant and a gold medalist in his graduate bachelor's of commerce. Please welcome with me Dr. R. Sitaraman. Now I'd like to call Dr. R. Sitaraman, Group's Chief Executive Officer of Doha Bank, to give the keynote address.
Your Excellencies, distinguished guests, dear friends, ladies and gentlemen, it's a pleasure and privilege for me to welcome you all for this interesting and exciting session. Today is also an important day for us to celebrate. We opened our representative office in Sharjah to cover the Northern Emirates. Doha Bank has been, thank you, has been a sustainable performer with a boom or downturn, sustaining its credibility as a best performing institution is what we committed as a mission. The committed vision of my board, professional execution of my management team, participative in substance, has been the success story for us to be proud of the fraternity which we are building in. It has scored in all dimensions. Socially committed as a green bank, professionally responding to knowledge society building, and again, best performing ratios in terms of, given the size of the shareholders' money, produced outstanding results in terms of return on average equity. Given the size of the balance sheet, again, return on assets. Shareholders' money, highest return, shareholders' money being deployed in the right asset allocation model to sustain as a best performer. We have committed vision to globalize. The principle-centered meaning is quite simple. It was in 2002, the globalization was on, deregulation was on, technology was converging, and consumerism visibly shaking up the global space. When the local market has become global, we said we will go global. That's precisely the reason we set in footprints today, world over, expanding. Wherever Qatar and the Gulf states have got economic linkage, we are there. It starts with first representative office we set apart from Qatar. We have 55 branches today. It was representative office, we set it up in 2004. We converted it into a full-scale operation in 2008. We have a second office commission way back in 2006 in Singapore during the IMF International Monetary Fund meeting. The governor of the Central Bank of Qatar has inaugurated. And again, it is Tokyo in 2006, Istanbul in 2006, 2007 was Shanghai, and again 2008 was South Korea, 2010 was Frankfurt, thereafter London, then this year we have switched on in Sydney, Australia, Toronto last month, October 16th, today, Hong Kong plus Sharjah is our committed footprints for us to support the global trade, investment and banking and finance. Coming to the specifics of today's content. With the changing face of the world, with the changing face of the financial service, new world order setting, reorganization and global transformation in substance. I was in Washington last month on the International Monetary Fund meeting. It was contentious for us to see whether world is still, global growth is on or not. The universal standard we sit in terms of accounting, valuation, securitizations needs to be executed. G7 has become G8, G8 has become G20 today. Politics and economics still needs convergence in substance. And that's what the world we are in. Financial economies are still really under pressure. Real economies are redefining their scope and performance. We live in an interconnected, interdependent world. Look at the IMF economic outlook. The global growth still less than 3%. It has been revised downward to 2.9%. Advanced economies still grossly underperforming. US tapering, that is, what has changed in the last 5 years is the liquidity. Liquidity has moved to funding crisis. Funding has become sovereign crisis. It has become a solvency issue for nations, continents. That's why we have seen Greece, Portugal or Italy, when the gross debt to GDP is outside the line and fiscal consolidation is needed the hour. If you look at the American substance, you have major challenges still to overcome. There are conditions which are mutually inclusive, making sure housing market has a sustainable recovery, ensuring consumer price inflation coming to terms, not less than 2%. Unemployment is contained to 6.5%. These conditions are mutually inclusive. Then, so-called the quantitative easing programs, printing money, improving the liquidity has inflated the stock market. Then, it has reflected, transcended borders, world over, hot money was swinging across. That's why you have seen reflection across the globe in the stock market. To taper that, to reduce the bond buying programs is an issue. Unless you have solid economic fundamentals, you cannot do that. Open market operations, everyone has tried. America has tried, not only QE1, QE2, QE3, that has stimulated the market and intensively, again, inflating the stock market. EU has got a different spell of problems. Monetary policy is centralized, fiscal policy is still not centralized. You need a fiscal union, you need banking union, you need to make sure the criteria which were set in terms of Maastricht Treaty, gross debt to GDP, deficit financing, should all be observed in the enlarged Europe. That's a difficult value proposition. It's a cultural makeup which needs convergence in addition to economics. When it comes to emerging markets, which are all coasting along very well. China has done 30 consecutive years, not less than 9%. India has done over 14 years, not less than 7%. Today is decelerating. Today it is slowing in its momentum. I was in China on 19th of July when the second quarter economic turnout was just 7.5%. World over, there were concerns expressed. India, as a functional democracy, is going through similar spells. When Federal Reserve was pronouncing in June 19th this year, there's a possibility of cutting down the bond buying programs. You have seen the reflection world over in the emerging markets. Currencies were absolutely in tandem going down. They were weakening and dollar was strengthening. The result you could see, extraordinary downturn in terms of growth prospects. That has destabilized the overall currency market. What happens when the currency gets weakened? It has got a reflection in the trade. You purposefully, as an accommodative monetary tool, you weaken the currency. That's what we have done in Japan. By this time last year, Abenomics was invented. Open market operation of trillions of yen was put into place. That has weakened the overall currency, and dollar index was having similar spell. Reflection, Japanese could export more. The economic recovery was in prospects, and Japan, Nikkei, you should clearly see it's over 40% up today. Currency war creates trade war. That's the substance. When you weaken the currency, people also hedge the risk by buying commodity futures that inflate the commodity prices. We have seen reflection in the oil price. Today, Brent is quoting 106 and WTI New Mex is quoting $90 to $93. That's not an ordinary spell. These are changes which needs commitments. In terms of global governance, G7 has become G20 today. These decisions, which have been spelled out in multiple meetings, London, Pittsburgh, and again St. Petersburg, a couple of months before, needs to be executed. You need to fix the tax havens. There's nothing as offshore. You need to fix the tax avoidance. Trillions of dollars have been defrauded. Money has been hoarded as a parallel system world over. Those needs to be brought in transparent terms. Those changes are pure conversion of financial economies, financial engineering to real economies. Those changes are not ordinary changes. Those decisions needs absolute political will, and scientifically we need to accommodate the monetary policy as well as fiscal prudence. That's not easy. That's not easy. If you look at the different spell of financial stability which we are witnessing in the Gulf states, it is commendable. We are insulated in terms of macroeconomic fundamentals. We are not isolated from the global financial crisis. Look at taking oil at $75 today. This is $1 trillion block, 1.6 trillion to be precise. Topping in the list is Saudi Arabia with $720 billion. Then comes UAE, $390 billion. Then comes Qatar, a small country with 11,943 square kilometers. Today is having commendable financial stability, costing over 200 billion as the GDP. Over 30% as the current account surplus. Nearly 55 to 60 billion is what we generate as current account surplus. And again, the rest of the states like Kuwait is producing 186 billion, taking oil at 75, and Oman is 72 billion, and Bahrain is 24 billion. Summing it up, it is clear, 1.6 billion. As a percentage of gross debt to GDP, you clearly see we are under control. We are all running in current account surplus. Current account surplus is over 20% in block for 6 states. And again, fiscal surplus, that is investable surplus, if you look at it, it's 7 to 8% in aggregate. That's not ordinary financial stability. If you look at the states, these states have now, in the last 1 year alone, if you look at the budget, perhaps the social progression has been visibly showcased now with the Arab Spring in the making. Healthcare and education projects in terms of urban development, airport, seaport, road, rail, network, everything is accelerated. That's precisely the reason every finance minister is showcasing considerable amount of government expenditure. That drives the change. Last year alone, 6 states put together, $377 billion of expenditure was committed. Again, topping in the list is Saudi Arabia, 121 billion. 116 billion is from Kuwait, 69 billion from UAE, 45 billion from Qatar, 24 billion from Oman, 8 billion from Bahrain. Summing it up again, it shows 377 billion. That's the kind of development expenditure is going to drive the change. We are expecting 2020 announcement in UAE. We have got the announcement done as far as FIFA is concerned, 2022. This is going to revitalize the space. There are huge amount of urban development, modernization. That is going to stimulate the market. What does it mean to the global trade? If you look at the global growth versus global trade, we have many things to be worried about. In normal terms, double the GDP should be the aggregate global trade. That's not what has happened in the last 2 years. It was 5.2% in 2011. It was 2% growth in 2012. There is a deceleration in substance. That's not a good story. Even after weakening the currency, creating a currency war, trade is not going through purely because austerity and value creations are mutually exclusive. The governments who have lived, individuals or institutions, countries or continents who have lived beyond their means, they have to come to terms in containing the expenses. When you start containing the expenses, when you don't have development expenditure, you don't have growth. You don't have growth, you don't have employment. And that's a dichotomy. Look at the budget resolutions, which is contentious in the United States itself. The entire IMF meeting was confined to political disarray. Whether the enhanced limits will come, whether the government could sustain its credibility as a AAA rated nation was the subject of discussions in IMF. That was very contentious. $16 trillion economy getting into the doldrum is not an ordinary phenomenon. That's the world we're in. That's not an ordinary situation. These are defining moments to convert the financial economies into real economies. Real economies like India, going through extraordinary current account deficit. And again, there's a possibility of fiscal consolidation which needs strong policy makeups. Politics and economics have to converge again. These are not stories. These are not fictions. These are absolute facts. How do we improve the trade? How do we accelerate the trade? Look at the trade growth. Developed economies are just doing less than 2% in aggregate terms. Developing economies, who are coasting not less than 4.6% as en bloc growth, they are producing between 4.4 to 4.8 export-import put together in average terms. That's not good. If you look at the UAE economy in particular, it's still going well. It was in 2009 in October when we had contentious property market downturn. I was in BBC. I was in CNBC. People thought Dubai story is fault. I was in CNBC. It was very contentious 20 minutes interview. It is in my website. Perhaps you can have a look at it. Have a look at it. It was contentious for me to showcase the total gross debt to GDP in terms of UAE as a nation is measurable, manageable, controllable. Property was overextended, but same time, it will bounce back with the vision ahead of time. That was my statement. Today, Dubai is bouncing back. Dubai is coming to terms. Extraordinary transformation. We could see clearly sitting as in a bank, debts are getting restructured. Rating agencies have put faith back on track. And again, we are seeing the symptoms of cash flows and liquidities surmounting to substance. And we are also seeing rental incomes are improving. It shows clear transformation. The road ahead is really interesting and exciting. The projects which we set in as a committed vision for all these states is going to stimulate the local market. We have seen the reflection last year itself. If you look at the UAE trade, in terms of India, it's 75 billion, topping in the list, bilateral. UAE versus India was 75 billion. UAE versus China was 50 billion. UAE was Japan was again 50 billion. UAE was Singapore was 25 billion. UAE was Turkey, again, it's 12 billion. I can go on. South Korea again, over 21 billion bilateral trade. In form and substance, UAE is moving in the right direction. GCC is moving in the right direction. But we need to understand the variances. We need to understand the nuances of the trade. We need to make sure we understand the risk as well as the return and integral. That's precisely the reason today we have coined this session. With me, a light panel full of extraordinary contents. To join me, we have fine legal firms, Al Tamimi, Katie Law, and again, a lady representation is very much there. And we do have Euler Homes to show what sort of risk cover we can profile. Mapping the risk is very important. Risk is measurable. Any form of business you have risk that needs to be mapped as an integral part of your overall functional makeup in terms of business modeling. And that's what we need to understand. Macquarie Bank is going to showcase the structured trade finance. What sort of realignment required in terms of understanding the conceptual frame of trade with the change in phase of the market, with the change in phase of the global framework. And again, we also have to understand the overall dynamics of the trade flows. To add value to this content, we have this elite panel. Ladies and gentlemen, at this juncture, I would like to showcase my global representations. Today we had the annual summit of international managers meet in Dubai. I would like to stand up. I'll request my colleagues to stand up and showcase their presence actually in the hall. To start with, I represent Doha and the whole world, global terms. But I have a UAE representative here. To start with, UAE, Dubai branch, Mr. Nail. Here we go. Abu Dhabi, Mr. Purdos. China, Shanghai, Mr. Peter Lu. There you go. Can you focus on the lights, please, there? Hong Kong, the new office we opened on 30th of last month. We have Mr. Ivan managing the China and Hong Kong office. Singapore, Mr. Satyamurthy, we opened in 2006. It's a terrific success. We do have representation from Kuwait. Unfortunately, has not been here. We have full-scale operation in Kuwait in 2008. We opened our office. Unfortunately, he couldn't join. Moving on to Sydney, Mr. Hilton. There we go. Tokyo, Mr. Kanji. We opened our office in 2006. South Korea, Mr. Kwon. That's a brilliant relationship for the Gulf. Istanbul, Mr. Nezi. Frankfurt, Mr. Mike. And the last but not least today, Sharjah, Krishna Kumar. Is he there? Here we go. Heading the team today, adding to the list is Mr. Ganeshan from head office, heading international banking. Ladies and gentlemen, it's a pleasure and privilege for me to welcome once again. I'm sure you will. Sorry. Canada. Oh, how can I forget Canada? 16th of October, we opened our office in North America. That's interesting. That's interesting. Here is Attorney Sekira from Canada. Canadian trade is improving still. That's the reason why. It's still you're doing 2 billion. You have to do more to UAE. Ladies and gentlemen, it's a pleasure and privilege to welcome you once again. London, Richard. Too many names for me to remember. By this time next year, I'll forget the total list now, I believe. Thank you one and all for your kind listening. Right. Let me invite the panel now. As I said, it's very important that we understand the risk profile when it comes to trade. To explain the risk, inherent risk, whether it is political risk or credit risk or operational risk, what sort of risk management we require to institute. How do we map them? How do we fix them when it comes to trade and related transactions. Let me have the pleasure of welcoming the gentleman from Euler Homes, Mr. Mahan. Give him a big hand, ladies and gentlemen.
Good afternoon, ladies and gentlemen. Thank you very much again, and I would like really to thank you for this great event and having these kind of speakers and talking about trade credit. It's a pleasure, and we from Euler Hermes side, we are really looking forward to provide how we can, in a way, support your business, your expansion, your growth, because we cannot avoid crisis. We cannot avoid challenges that we are facing every day within the trade norms. But of course, we can somehow give you the comfort how you can trade in a safety way and in a different way. Euler Hermes, part of Allianz Group, and owned by 68% by Allianz, is market leader in worldwide in trade credit insurance. We have around 6,000 employees worldwide, and we are from Dubai operating and responsible for the whole Middle East, starting from Egypt up to Pakistan. And with our exposure worldwide, we are in a way supporting the trade receivables up to 780 billion euro exposure up to date. This is the current figures more or less by yesterday evening. In terms of GCC, we started in 2006 with our operation, and we have around 11 billion euro exposure within GCC. I very much remember the days where we had the Dubai crisis, and we focused very much to the region. We said as a first status and statement, we are committed to the region because we believe that GCC will come back again, and especially Dubai. And I remember at that time we had only 2.8 billion euro exposure, and today is by 11. And the growth is around 58% every year. We are talking about 45,000 active businesses that we are really supporting in daily transaction, B2B. And also we are enjoying the AA- grade of Standard & Poor's worldwide. We provide our customers, and also this is something which we can also provide each and everyone on our website. This is the global risk map, and this is exactly how we are focused to target, to more or less analyze worldwide economies. And this is how we see at the end GCC and Middle East region, dark green. That means it's a very low risk, or is benefiting from the highest rating at Euler Hermes Group, like in other countries, European countries, or North America. And of course, we are moving in a level or area that we have also very high risk, if you are talking about the neighborhoods, if you are talking about the countries which are of cover. But we see that the expansion of GCC clients and also companies, SMEs to Africa is growing much faster than to Europe or Asia Pacific. And this is something where we want really to put our map and a roadmap to say we want to be the expert also in Africa with local expertise. That's the reason we have around now 70 people in Dubai looking after the risk management of the whole area.
Tell me, credit insurance covers what type of risk? What are the types of risk credit insurance covers?
Technically, we are covering whatever it is B2B, between B2B, within 180 days short-term trade credit. But we are, if you're talking about the type of risk, we are not only covering B2B private, we are also covering government, countries, and obviously also public buyers. We call it public buyers. So therefore, whatever is tradable, we are looking forward to provide a solution for.
That's interesting. How do you categorize or prioritize the risk in terms of whether it is a political risk or a credit risk or a price risk, for example?
I start to answer this question with a clear message. What we are providing is information, and without this information we are not able to assess the risk, measure the risk. You mentioned every risk is measurable, and we have only to commit to the information which is available, and not only the financials, because at the end of the day the financials are just figures, and they can change by 1st of January if the company is closing by 31st of December. So at the end of the day, we are really analyzing the sectors, we are considering the environment and the countries, and last but not least also taking into account knowing the client on the risk. We have to be a sparring partner of our clients in order to understand their business and their requirements.
That's interesting. How does the credit insurance helps for the GCC exporters or importers?
Now, just coming back again to this particular slide, because we are in Dubai, and just to see what is happening really around Dubai. You see that Dubai export and re-export are increasing and showing an improvement. Even in 2013, we received a message that around 7,000 new members were registered, which is significant for such a city or UAE as a country whole. Then, of course, if you look at the newspaper yesterday, today, even on Sunday, the announcement for the air show, all the expansion, obviously Dubai is the hub, or UAE is the hub for not only for the region, global-wide. And last but not least, GCC banks are very much involved in trade finance. They have the appetite, and they are very much looking to support their businesses with vendor financing or invoice discounting, upstream, downstream. Now coming back again to the typical slide, how we are assessing risk. On the left-hand side, you see a lot of information are published, and you receive it like, from the credit reform or Dun & Bradstreet, but which is exclusive to us is more or less the client information. We would like really to have this kind of information from the clients. We have a excellent payment performance data, and we have in each and every office worldwide a risk office network. That means we are having people on the ground, not only the people which are having authority to sign off a limit, but also people which can really understand the businesses and also the nature of the businesses. This is giving us the comfort to say we are the local expert in the market, and not only via London or via Paris or via New York. So we are really based on the ground, and we would like to walk with you, with the partners, and also with the banks in order to support the trade credit. We are also grading the buyers from 1 to 10. 1 is obviously very strong, and 10 is insolvents or Chapter 11. And this is something which we are sharing with our clients in their portfolio. And also coming back to the main outlook that we see in GCC for 2013-2014, obviously in petrochemical we see that the forecast for more or less within the next years is up to 200 million tons. We see that the banking sectors in GCC is doing extremely well. The top 10 banks are really increasing and growing by 16% by end of second quarter 2013. We see a lot of movements in IT and telecommunication. It's a very dynamic and also diverse sector which we are supporting fully. Construction sector, coming back again to your point, obviously Saudi, UAE, Qatar are really dominating this sector with their growth, and we are supporting also these businesses. And last but not least, FMCG, food and retail. This is something where we see a lot of movement also here, and we are looking forward to take more risk on our books in these particular sectors. I found this slide very interesting because Qatar is very much close to be within the top 10 productive global economies worldwide, and UAE is for the first time within top 20. This is showing where the growth is coming from, not in Europe. It is here, it is right now close to us, and we have to try to maximize it to the highest level, but again moving very cautious and taking or minimizing the risk as far as possible. ULMS GCC main sectors, just to give you a very short update where we are very much active. In IT sector, FMCG, metal and construction, petrochemical, these are the dominating sectors. And obviously this is the share where we are with 11 billion euro right now active in these sectors. And last but not least, just giving you a short heads up how we can support your business. Obviously we are ready for solutions for receivable protection. At the end of the day, we have a very custom-made solution. We would like really to analyze your business and see where is the need for this level of products. And of course, we are sharing with you our latest market updates on each and every country. And we are doing also risk workshops so that you and your credit management and salespeople are really, in a way, measuring your risk in daily business so that you are moving again with safety and somehow with some comfort we can provide to you. So again, thank you very much. I'm looking forward for this exciting evening with a lot of excellent speakers, and I am open now for questions.
Any questions to Mr. Mahan, Hillary Holmes. He condensed it. Since I specified him 10 minutes, you can ask questions. You are entitled to ask questions. Any specific sectors which you can derive maximum benefit, Mahan, from the credit insurance?
You mean in this region?
Yeah.
Obviously, FMCG and petrochemical. But again, we are completely committed to each and every sector, so because we want really to take it to the next level, and we are committed to the region. Obviously, we have the appetite, but we are looking forward for your business and also for your, let's say, risk in order to minimize it along with you.
Ladies and gentlemen, you're all businessmen. Here's it. Please.
Hi, good evening. This is Mahin from Hakan Group. I know for credit risk there are 2 or 3 major players in the industry, Atradius, EH and Cofas. I'm pretty sure in terms of your risk appetite, you will have, some segment of or some regions you will have a priority over the other competitors. Which are those sectors? Like India is one of the market, Turkey or Europe is the second market, Africa is the second region. So where do you have a greater presence than compared to your other competitors?
Let's talk about us, and with all respect, we have a very unique business model. Our business model is saying we want to be on the ground with local expertise. I referred in Doha to the Doha Bank slogan, which is also outside. Local expertise is very much important, and that's the reason that we are very much investing where we are operating. So having 70 people from local businesses here is allowing us to have a huge appetite, because we know what's going on the ground. This is one thing. The second thing is, obviously, because of Allianz and AA- grading, which we are enjoying, we have much more expertise, much more appetite in taking risk from the reinsurance point of view. And last but not least, due to our size of the business, being worldwide operating with 780 billion euro exposure and 40 million companies in our database, we have an excellent also network in terms of knowing the risk not only within this region but also abroad. So this is allowing us a little bit being different than our competition, and obviously as I highlighted, our appetite is in each and every sector within the region. Sometimes more, sometimes less, but again is a custom-made solution.
That's right. Any other questions? One more question, if at all. Right. Ladies and gentlemen, let's give a very big hand to Mr. Mahan.
Thank you very much.
Thank you. Right. When it comes to trade finance, we need to recognize the legal framework. We need to conceptualize what are the advantages of having trading for free zones, perhaps. How does the GCC-wide the model changes? We need to conceptualize what are the issues behind, legal issues behind the trade finance transactions. To elucidate further, ladies and gentlemen, let me have the great pleasure of welcoming Mr. Judy Waugh from Al Tamimi and Company. Please. Make sure you show Al Tamimi.
Good evening, everyone. Firstly, thank you to Doha Bank on organising tonight and the kind invitation to participate. What I would like to do very briefly tonight is talk about some practical legal issues that can impact on trade in the region. I've picked 4 main topics that I'll discuss briefly, and also highlight some trends and some issues that we see. And lastly, just end with some developments in the UAE in particular, which directly and indirectly impact on trade. Obviously, legal issues and trade go hand in hand. With any businesses coming to the GCC have to take consideration of the local laws and regulations which they have to comply with. For many foreign businesses that come to us, it's a learning process. They're coming from perhaps more developed common law jurisdictions, and they're not used to the civil law jurisdictions of the GCC. I think the other important thing to remember is that the GCC systems are developing. The legal systems are developing. When I first arrived in the UAE during the boom, pre-financial crisis, it wasn't uncommon for our banking team not to actually discuss documentation with our litigation department because deals were being done so quickly. In 2007, we as a firm had not done a case for foreclosure. Now, 4 or 5 years later, we have 300 or 400 cases. So there is a developing legal system throughout the GCC. The first issue that I've identified is the ease of setup. Obviously, any business coming here to do trade, the key consideration for them is how easy is it to set up in the various jurisdictions. And each of the GCC jurisdictions have foreign investment restrictions, which are dependent on the relevant jurisdiction and in a lot of cases the relevant industry or sector. In Saudi, for example, there are differences between whether you're in a trading sector, industrial or service, and that can dictate how much foreign ownership you're able to have. The one problem with that is that other than some of the free zones, the actual setup process can be quite lengthy and to people that are not familiar with the process quite daunting. There have been changes to the foreign investment laws proposed in the UAE, but unfortunately they were carved out of the company's law and have been delayed. And even when they are implemented, they're only going to relate to certain industry types. We've also seen in Saudi the licensing authority becoming a lot more stricter with their licensing, which has slowed down the process. In Kuwait, however, we have seen that through the economic zones, that the speed at which companies can be set up has greatly improved. So going forward, I think for the GCC, UAE is perhaps the role model. We see industrial financial zones which offer a good transparency for businesses trying to set up here. It's very quick and easy, and in many cases it's a familiar process to businesses trying to set up here. We have seen this trend be replicated. You've got the QFC in Qatar, we've got economic zones in Kuwait and Saudi, all aimed at improving the ease in which you can set up. And I think if you look at the DIFC, for example, after the Arab Spring, that was one of the contributing factors which led a lot of people to relocate to the DIFC and saw its revival. Tax is obviously a major consideration for people doing business in the GCC, and traditionally it has been a very attractive proposition in this region. There are corporate income taxes throughout the region, although Dubai, well, the UAE has a limited tax system on foreign banks and the petrochemical industry. We are aware that the UAE government has considered a low rate of corporate income tax, but as yet not implemented. We've also seen the customs duty being fairly uniform throughout the region, although we have seen some member states using exemptions to protect certain industries or products. VAT has been discussed but not implemented, and just recently the remittance tax has also been discussed but not implemented. And when you see the level of remittance from the GCC countries, you can understand why governments may start to look at that as an option. I think the real challenge going forward is the growing populations, the growing economies, and growing expenditure of the GCC countries. And obviously that puts a strain on the income, and tax is obviously one viable option to fix that. But it obviously has to be balanced against the cost of actually implementing taxation systems and not wanting to limit or put off businesses wanting to do trade in the region. Trade finance, fortunately the GCC countries are founded on trade. So the legal systems promote trade, they recognise the trade finance, the structures, they're compatible with things like the UCP. So we don't normally see a lot of issues in structuring finance for trade finance. on a very practical level, what we do see is that ancillary issues get in the way. So if you take the UAE, for example, most of the trading companies are LLC companies, and their wealth is in their inventory and their receivables. But when you look at the limitations on taking share security over LLC companies, you look at the non-availability of a floating charge over inventory, and although these companies can get trade finance, they perhaps can't unlock the wealth of their assets because of the limitations. The last consideration is dispute resolution. Any foreign business coming into the region is concerned about what happens when problems occur, what happens when things go wrong. And unfortunately, in our view, there's a apprehension towards the local courts and the local law, which is often unfounded. One of the main questions that we often get when foreign businesses come to us is how will Sharia law or how will Sharia courts deal with the dispute? And in the UAE, what we often try to explain to them is that Sharia law does not apply to commercial transactions, and the Sharia courts don't have any jurisdiction over commercial matters. So it's this sort of presumption that somehow they're different to Western jurisdictions, or they'll be slower or more complicated or uncertain, that we often have to educate people on. And I think the important thing when it comes to dispute resolution is there are many choices, but people have to make informed choices. So foreign law, foreign forums or arbitration are suitable in some situations, whereas local courts will be suitable in others. And people really have to understand the options and think about specifics. Where are the other parties located? Where are the assets located? Where are they likely to enforce any judgment they get? And will that judgment actually be enforceable? So sometimes we do see, whether it's in financing transactions or trade transactions, people are not making informed decisions, which can have quite dire consequences. Just lastly, I'd just like to point out a few developments in the UAE which relate to trade. We've seen the DIFC courts expanding their jurisdiction, so you can opt in now. We've also seen them sign agreements with the English courts and Ras Al Khaimah. We've seen the Abu Dhabi Global Market announcement, which will launch in 2014, which is likely to focus more on commodities, but it will be a full-blown financial market. DMCC TradeFlow, which is the online platform for commodities, and we've already seen the launch of that platform, and we've seen it used by Islamic banks for their treasury purposes. The UAE Companies Law is approved and hopefully enacted soon. And one interesting point is that it will allow LLC companies to pledge their shares. Enforcement of foreign arbitral awards are increasing in the UAE, and we'll also seen the Credit Bureau and the direct debit system introduced, which will come into force in the next few years. We've seen the central bank increasing its regulation, and on speaking to the governor, we can expect more regulation amendments next year. And finally, we've seen at least a draft of the secured financing law, which may help SMEs and trading entities offer security to lenders. So that's all I had for tonight. Thank you very much, and hope you enjoy the evening.
It was very well presented from Jody. Any questions to Jody? Jody Wong? Yes. Can you pass on the mic, please?
Well, UAE emerging as one of the top destinations in the light of ease of doing business. So, what are the two major challenges and opportunities you would look at it from the perspective of the legal angles? Now, on the one side, you are looking forward to the changed legal perspective and dimensions. On the other side, the government is doing all that it can so that it can attract foreign investment and business houses. So two major challenges and opportunities from the legal perspective.
I think the main opportunity from a legal perspective is further development. One example is the free zones. if you look at from a lending perspective, so new businesses actually trying to get lending in free zones, there's no consistent set of security regulations across the free zones. Lenders can't always take the security they want, so that inhibits, businesses that set up in these free zones taking security. There is also limitations in terms of onshore security, and again the availability of finance, because these assets are not actually available. And I know that the government has done studies on. They have come to us in the past to say, if you could improve something, what would it be? And quite often, I'm a banking lawyer, so it's in relation to how easy can banks lend, and how easy can companies obtain lending. There's things like company searches. Outside of free zones, it's not possible to get a company search. So there's a myriad of improvements that can be made to the legal system to make trading and financing of that trade much easier.
Good. Sir. I got one question to you, Jody. How far the local laws and ICC rules synchronize with each other? For trade finance perspective.
I think it's a difficult question, because now there's almost too many options, because what we are seeing is you've got the ICC, you've got DIFC, LCIA, you've got local DIAC, you've got an Abu Dhabi system, LCIA in London, and it's very difficult for example, in a financing transaction, for lenders to actually make a decision, because there's no clear answer on which is preferable in a certain transaction. So I think the answer is that it is on a case-by-case basis, and I think they're all compatible, but often it relates to where do you want to enforce an award that you get, and what governing law do you choose.
Interesting. Ladies and gentlemen, give a big hand to Jody Wall. Thank you. Right. We looked at the legal perspective. We have to look at the public policy. The policy makers make the trick in terms of the overall trade flows. There are contentious issues between developing world and developed world. And also, there are, as I mentioned, currency war now is creating new sensations. There are new opportunities. For example, Chinese yuan, renminbi, has got trade settlements in many countries by entering into currency swap with the central banks. UAE has entered into with Chinese central bank for $5 billion. Directly you can settle through yuan. There are interesting developments. To elucidate further, ladies and gentlemen, let me have the pleasure of welcoming from PwC, Philip Lemmers from Germany.
Excellencies, Dr. Sitaraman, thank you very much, Doha Bank, also for inviting PwC to speak at this conference. Distinguished audience, it's my pleasure to be here. It's an honor to speak about a topic that's been gaining a lot of traction in the region, in the GCC, and also in other parts of the world, in Europe. I'm going to elaborate further on this in a minute. We're talking about trade. We're talking about trade finance tonight. And trade is, to us, not only shipping things from A to B. Trade in this region means something else. I thank Jody for saying the economies in the region are based on trade. They're founded on trade, which gives great opportunities to also utilize trade in a manner for policy making, not only for financing, but also for policy making, in a sense that trade and exports play an important role in the development of the economies. They play a role in the diversification of economies in the GCC. They can play a role in knowledge basing the economy. They can play a role in developing and having exporters participate in international value chains as well. So the policy aspect in trade is really important, and as we've seen, Dr. Sitaraman mentioned the downward amended numbers in global trade, but we're still seeing, after the crisis 2011, we see the numbers pick up, and we see an estimated growth of around 4.5% in global trade, estimated for 2013. So we see a lot of good improvements there and a lot of opportunities that lie within this growth for the GCC countries. At the same time, of course, the fact that global trade grows brings along the necessity to finance this growth. And again, Jody mentioned one aspect of this as well. We're seeing an estimated number of $38 billion worth of trade finance in 2015 estimated, almost or more than doubling from a couple of years ago, meaning that there is a need for finance, and also looking at the very flat lending levels towards especially small and medium-sized enterprises in the region. Again, a policy aspect comes into play when we talk about how can governments actually help SMEs to get access to finance. The question was raised by the Global Business Index. What is the main challenge? It's getting credit. It's still getting credit, and let me go into that a little later. But first of all, touch on one other point. We're also seeing in this growth of trade, we're also seeing changing trends. We're seeing trends from traditional trade to South-South trade, number almost doubling since 2001 to 2011 and 12, and we're seeing more growth in that till, as you can see, till 2020 we're expecting this to be at 33%. This change in the weight of trade and the, say, geography of trade also brings along the trend that we need other currencies to finance this trade. We've seen a rising role in the renminbi finance, in trade finance, 4% of global trade currently. I want to mention that almost 20% or double-digit numbers of trade is financed in renminbi from exports from China to the world. Still the US dollar, of course, with 84%. A lot of weight, a lot of great importance. However, other currencies in this changing role also picking up traction. What does that mean for the MENA GCC region? You can capitalize on a lot of assets. It's been mentioned by the colleague from Euler Hermes that the trade relations to Asia Pacific region are with more than 50% of exports from the GCC MENA region going there. Excellent trade relations. We have excellent relations to North America. We have a big increase in Europe, and we're also seeing, of course, Africa gaining a lot of importance with 5% for the UAE, a little less in the GCC average. The thing that I want to touch upon in this context is that if we look at the rising numbers in export on the one hand, we also see rising imports in these countries on the other hand, giving a good indication that the UAE and the GCC countries are capitalizing on the growth in these countries as well. So we're having a rising import on the one hand in these countries, and we're having rising exports from the GCC. And to maintain that trend and to participate in that growth, it needs finance. And this is, as you can see, still with an average of 102 place 102 average for the GCC. Some countries in the 130s, talking about Qatar and Kuwait, and better in the UAE, where we're having the challenge of how can especially small and medium-sized companies get access to finance. Well, again, a policy aspect. We've seen export credit agencies, so public promotion tools being established to fill this financing gap. We've seen other innovation programs trying to set up to fill this financing gap and to ensure good security and collaterals for the SMEs to capitalize on commercial bank side. So the access to finance, if we look at the lending level towards SMEs, we have a penetration of around 0.5% in Qatar, 1% in Bahrain. We have an average of 3.3% in the GCC average. So there is the access to finance level is very difficult especially for smaller enterprises that form the backbone of economies in large exporting companies, in large exporting countries all over the globe. So if there's a need and a want to grow this SME sector to become part of this backbone in economies in the GCC, it's necessary to lay the ground for good financing in export. The fact that that it's not so easy to get access to finance is probably going to be multiplied by the effects that Basel III regulations underway can have as an impact. The industry says they're expecting a rise in trade finance price between 18 and 40%. At the same time, or how did these 18 to 40% come along? Well, the Basel III has a qualitative and quantitative necessity for banks to fill up their equity. And at the same time, from the leverage ratio side, the fact that trade finance itself is not as risky is not reflected in the leverage ratio itself. So it has to be accounted for 3% of the equity on the equity side for trade finance. That's not risky by the numbers that you can see on the right at all. But there is, as you probably all know, there is a trend towards easing these regulatory rules in terms of the one-year maturity floor for LCs, as well as the 20% conversion rate down from 100 in that context. I've been talking about policy making and how can politics and policy help SMEs or corporates to gain access to finance in the region and globally, actually. But there's also things corporates can do themselves to one, adapt to the changing environment, and to help banks actually to lend the money and to make them a player in trade finance. For example, I just want to give a little case study we've done on global headquarter level for Siemens and LG management project, where we assessed, first of all, their bank letter guarantee lines globally in 3 dimensions. We've looked at volumes, we've looked at maturities, and we've looked at banks. And what we found is that the level of letters of guarantees they had was way too much for their operations, 1. The maturities didn't fit, 2. And 3, it was too many banks, so they didn't have the overview from the headquarters. And at the same time, they were paying much more than they had to for the same effect. So the outcome was they could reduce their cost by streamlining the maturity dates. Banks gave better conditions for the letter of guarantees, so reducing cost, and at the same time still not losing the positive effects of letters of guarantee by balancing out the needs and the financing side of it. A structured approach towards country risk management, and that's something I personally always find very interesting, not only from my history in the German ECA business and foreign direct investment insurance practice, but also from a perspective of, let's say, corporate operations. 32% of corporates say they don't specifically account for country risks in their operations. More than half of corporates that we interviewed say they use it to some extent, but not regularly for strategic decisions. And only 75% of the corporates that we interviewed said, yes, we use country risk information, but only in terms of M&A and investment decisions for risk mitigation. So what lies within that? What we do is we look at indicators. For example, I've taken the CLI indicator from the OECD in this context to highlight and to showcase the great potential that lies within strategic country risk management. If you look at the indicator, it will give you obviously a good picture of the CLI index itself versus the GDP of Brazil in this very example. And what you can see is you can see the indicator drop to negative 6 to 9 months before actually the GDP turns negative or becomes into this downward slope. So what does that mean? For a corporate, it means if you watch these indicators and if you apply this into your corporate strategy, you can make decisions way ahead, or 6 to 9 months ahead for your own risk, and also, of course, ahead of competition probably. So there's great opportunity in terms of risk, but also there's great opportunity in terms of chances. The same applies, the same 6 to 9 months apply towards the positive trend. So 6 to 9 months before actually the country's GDP picks up again and your business most likely will pick up again, you see the indicator making a positive trend. And of course there is different indicators that can narrow down this framework to becoming even more precise. And just one last comment, if you allow me. We heard some of this as well from Dr. Sitaraman in his opening remarks. Countries that have great opportunities involve some risk. And there's different means to mitigate these risks. if you look at, for example, China with GDP growth that you can participate in, if you look at India, Russia, Turkey, of course they all have a certain risk profile. But if you look at Europe, that's in this case Germany, because I couldn't leave home completely out of this. You see a very low risk profile, but you also see very low growth rates. So there's not much opportunity, again, against the low risk. So how can you mitigate these risks, and how can you actually make a chance out of the risk by using ECA, for example? You have in Dubai, you have the ECIE, the export credit insurance, that can even go into markets that are impossible for Euler Hermes to go to. So there is the opportunity to even share these risks with parties that are on the policy level. And again, I would like to thank you, first of all, for the opportunity to speak, and I hope this is some food for thought that you can discuss over dinner or with me or with any questions you may have. Thank you very much.
Definitely food for thought. We are all getting set for the dinner as well very soon. 2 more speakers to go. Any questions to Philip? One question here.
You have touched on the SMEs financed by the banks and the hesitance of the banks down here to promote the SMEs. What do you think why the banks and the financial institutions don't have this appetite for the SMEs, and keeping into consideration they are key drivers, as you have mentioned, for the growth of the economies down here? Good question. But not Doha Bank. Doha Bank has taken a prime market share in Qatar. We are also financing here. SME is the backbone of financial stability, creating employment and wealth distribution. Do you have an answer for it?
Yes, sure. Thank you, first of all, for the question. Yes, I mentioned the bank's appetite to finance SMEs on the one side. Of course, it's not only banks. I think there's a lot, and I wanted to mention 2 examples with the LG management, for example, and the risk country risk management. These are, of course, internal measures in the corporate itself. So what's in between? To my personal opinion, it's a regulatory thing. If we're looking at insolvency law or non-insolvency, if we're looking at bookkeeping, I'm from an accounting/advisory firm, so this is very close to me. If we're looking at accounting standards, if we see that in underwriting decisions of any insurer, it's just simply very hard to identify and to quantify the risk. Of course, the bank will not have the appetite it would have with a sound bookkeeping and standards that are just in place. So it's a regulatory issue, to my personal opinion, as well.
Good. That was Philip from PwC. Ladies and gentlemen, give him a big hand. Thank you. Thank you, Philip. Right. Today we have got very many dignitaries. My Vice Chairman, Mr. Ahmad Yusuf Obaidan, is here. The Consul General of Qatar is here. Canadian Consulate is here. So we have very eminent people are sitting across and listening to these inputs. Let me move on to the next one. He's a banker. In substance, he has to define what is a structured trade finance and what does it mean in terms of trade flow. How do we integrate a transaction end to end? These questions need full understanding. To elucidate further, ladies and gentlemen, let me have the great pleasure of welcoming Rohan Westcott from Macquarie. Give him a big hand.
Good evening. I would like to start by saying that Macquarie is honoured to be asked by Doha Bank to speak about structured trade finance. I thought I would give a quick overview of Macquarie and the Fixed Income, Currency and Commodities Group by way of explanation of what our expertise is when we partner with Doha Bank. Macquarie was founded in 1969 as an Australian merchant bank. It has grown to be a global provider of banking, investment, advisory and funds management services. We have nearly 14,000 employees in 28 countries. We have Aussie dollars 385 billion of assets under management. We are listed on the Australian Stock Exchange, and we've maintained our single A rating with Standard & Poor's for the last 22 years. The Fixed Income, Currency and Commodities Group. This group is responsible for financial and commodity markets. It specialises in commodities, Asian and emerging markets, high yield and distressed debt. In terms of commodities, we have covered metals for 30 plus years, agricultural commodities for 20 plus years, and energy for 10 plus years. In terms of products, we cover the full spectrum: investor products, finance, sales and trading, research, and physical businesses. Some facts and figures that we like to highlight to people. We are the number 4 physical gas marketer in North America and the number 1 non-producer. We have the number 1 rated global commodities research team, and we have physical businesses in oil, coal, power, LNG, natural gas, freight, base metals, iron ore, and sugar. Just quickly, I thought it was worth mentioning the desk that I work on, Trade Solutions, and how we partner with Doha Bank. Our Trade Solutions approach is to understand our customers' flow from the supplier through to the consumer and then propose a solution. We have expertise across the commodities and discipline spectrum with teams located in Singapore, London and New York. We work with a regional expert like Doha Bank so that we can provide the best solution to a customer. Doha Bank's award-winning wholesale banking group has over 34 years of trade finance experience, making it the perfect partner for Macquarie and for Doha Bank's customers. So on to tonight's topic, structured trade finance. I thought I'd better define trade finance. To me, trade finance is a third party, usually a financial institution, facilitating the sale of goods from seller to buyer through providing finance. But to put it much more simply, it's a sale of goods financed by a third party. Some examples of trade finance products that I'm sure you're familiar with: bank guarantee or standby letter of credit, simply a promise to pay from a bank to the seller if the buyer fails to pay. A documentary letter of credit, a promise by a bank to pay the seller if the seller hands in the correct paperwork. And discounting of open credit or LC receivable, a bank paying the seller up front and waiting to be paid by the buyer at the due date. I think it's worth mentioning these types of products as they're building blocks when you come to a structured solution. So, I thought the best way to talk about trade finance versus structured trade finance was to use some facts. Our panel members have talked at a high level about trade. I thought we would go down into an individual cargo. We have a customer that has bought a cargo of oil. They bought it at Load Port Bahrain. That means that they are responsible for picking it up there, so they bought on a FOB or free on board Incoterms basis. We just talked about letters of credit. They have a bank that is willing to pay their supplier on behalf of the customer. But first, the bank requires the customer has a guaranteed buyer who has already supplied a letter of credit. This is known as a back-to-back letter of credit facility. Our customer has spotted the opportunity for a higher price if they are able to move the oil from Bahrain to Jebel Ali, store it at one of the terminals, and sell it to a customer at a later date. The back-to-back nature of their letter of credit facility means that the customer can't move the oil, they can't store the oil, and they can't sell it at a later date. Their only option is to sell it at the load port. So what is structured trade finance? We just saw an example where the cargo couldn't be moved, stored, or sold at a later date. The customer still had a need outside of the traditional trade finance product. Structured trade finance is for these situations. It's about filling gaps. It's about solutions rather than the customer having to fit into a particular range of products. The solution could be delivered by a bank acting as a traditional bank, acting as a physical counterparty, or a combination of both. So let's go back to our example and look at it using structured trade finance. What would the approach be? The bank would place an emphasis on the value of the oil for the bank to be repaid and to mitigate its risk. They would look at the specifications of the product, they would look at the markets that it can be sold into, and they look at issues with a particular product. The bank would want to own the oil rather than lending against it. Why? They can have better control of the oil at every stage of the trade flow, and it's easier to sell if there is a problem. Some of the panel members have touched on Basel III. By owning the oil, there is better capital treatment. Rather than having to speak to a regulator about the oil being able to be held as eligible collateral rather than cash or gold, the bank is able to own that asset. If they're able to take a prepayment to mitigate risk, they are able to further reduce their capital. The bank would use buy and sell oil contracts rather than bank loan documentation. The customer is more familiar with this type of documentation. If we look at a particular example of the mechanisms within an oil contract, you will see that the mechanisms are already there and can be tailored to the solution. So, quality and quantity is usually determined by an independent inspector. We can change that so that the cargo is picked up by the customer on an as-is basis. The bank may require a percentage of the oil value to be prepaid by the customer in case they don't pick up the oil on the due date. The bank would use this amount to cover their costs if they had to sell the cargo to a third party. As I mentioned before, the prepayment can also be used to reduce capital that needs to be held by the bank. As the owner of the oil, the bank will ensure its value rather than the customer being responsible. So what is the solution? The bank would buy the oil from the customer or its supplier. The bank would arrange freight to move the oil from Bahrain to Jebel Ali. The bank would arrange to store the oil. They would either take a head lease from the terminal or they take a sublease from the customer and have an acknowledgement from the terminal of the bank's ownership rights. Up front, the customer would agree to buy the oil from the bank in the future, securing it with a prepayment. They would buy the oil on the same quality and quantity that the bank did, so they are buying it on an as-is basis. They would cover the costs of the bank, including the bank's margin, and this would be built into the price that they pay for the product at a later date. The customer can pay for the oil by cash, letter of credit, or assignment of open credit or letter of credit receivable. So our customer has been able to pay for the oil at the due date by cash, letter of credit, or assignment. Our customer has been able to move the oil, store the oil, and sell it later to capture a larger profit. Our customer has also only had to fund the prepayment, which is an efficient use of working capital. The bank has funded everything else. The oil was not on our customer's balance sheet until they picked up the cargo. This is just one example of structured trade finance situations. Others might include voyage finance for related parties or customers asking for extended payment terms in local currencies. We've touched on the fact that RMB is becoming more of a trade finance currency. We've certainly seen it pick up in customers asking for extended payment terms in RMB. Hopefully this has given you some insight into structured trade finance and its solution-based approach for customers. Thanks very much.
That was Rohan Descott from Macquarie Bank. Any questions to Rohan?
This is for Dr. Sitaraman. See, Dubai, as you are aware, Dubai is a trade hub, and Qatar is going to be one of the biggest partners for us. We see a lot of developments happening in Qatar. It started with the Asian Games. Now we are seeing the World Cup and many more to come. And Mr. Mahan is also sitting next to you. And our major concern in this part of the world is the receivables. We are talking of the globalization, and we are getting our receivables. Our major concern on the receivable is on the risk factor and the working capital. So now, as far as the risk factor is concerned, Mahan gave us a briefing, and we are very comfortable and hope that EULA will take care of our risk. And the second concept is the cash flow. Now, we are working with a lot of GCC countries, and Kuwait, central bank is allowing us to open a call deposit account there, and we are able to collect the PDCs, we deposit the PDCs there, and the money gets automatically transferred on the next day. Can you throw us some light on the in-country regulations and the central bank regulations in having these type of the facility in Qatar without having a company inside Qatar?
That's an interesting one. Instead of me answering, the lady next to me she's going to talk about receivable financing in the UAE in specific terms. I think she will be answering most of your questions. Rather, you wait for the presentation from Natalia. That will be an interesting content. You should watch. Then I'm going to answer to you at last. Rohan, thank you very much. Let me have the pleasure of inviting Natalia aboard from K&L Gates. Very interesting question it is. We have to understand what are the risks involved in terms of legal alignment when it comes to receivables. How easy it is or how difficult it is. What are the various enforceability aspects? We need an answer. Here is the lady from K&L Gates to explain to you further. Over to you, Natalia, please. Ladies and gentlemen, give her a big hand.
Good evening, ladies and gentlemen. I'm delighted to be here this evening, and I would like to thank Doha Bank for giving K&L Gates the opportunity to be represented at this prestigious event. I'm very conscious that I'm the last speaker this evening, that I come after several highly esteemed co-panelists, and perhaps more importantly that it's very close to dinner time. So I'm going to keep this presentation as snappy as I can, at least as snappy as a banking and regulatory lawyer can, and I'll be pleased to take any questions afterwards. So in terms of trade receivables financing in the UAE, as a banking partner at a very large global law firm, we're seeing an increasing number of these types of transactions coming to us. Rohan touched earlier on the definition of trade finance, and the definition of trade receivables finance is clearly not too far away from that. Essentially, it's the sale by a company of its trade receivables, i.e. invoices, at a discount to a factor, which is a bank, or in a securitization, a special purpose vehicle, which assumes the risk of the debtors and receives cash as those debtors settle. The growth of trade receivables financing in the UAE and more widely across the GCC has been very significant over the last few years. And why is that? Well, it comes as no surprise to all of us that as a result of the global economic crisis, companies need to find alternative financing solutions. The lending markets have been difficult. The debt capital markets are probably not open to all companies. Even in the UAE, bank lending significantly dropped since 2007, and although there was an increase in 2012, it was quite small, 3.3%. But that being said, and we've heard from all of my co-panelists this evening, in the UAE, trading volumes are extremely high. In 2012, they exceeded 325 billion dirhams, and the UAE has posted its highest global trading confidence since 2010. Recently, HSBC, which is very active in the trade finance market, conducted an extensive review, and as part of that review, it interviewed over 300 UAE SMEs, and over 50% of those SMEs said that they expected their need for trade receivable financing to grow significantly in the next 6 months and into 2014, which is great news for us lawyers. So why is it so attractive? It's attractive to banks and companies. For banks, these receivables are self-liquidated, they're short-dated, they can be part of revolving facilities, but more importantly, it gives banks access to a huge variety of receivables, including foreign receivables. They're less volatile than consumer receivables, and they're less affected by the economic crisis. Even when a company's business declines, it's still generating receivables. And so trade receivable financing is still a way in which companies can seek to raise money. Companies, because trade receivables financing transactions can be set up on a revolving basis, it ensures long-term financing strategy. More importantly, the costs are lower. It's lower than borrowing from a bank. It's lower than setting up a securitization. It's lower than going into the debt capital markets. Deal size can vary, deals can be revolving, It's more flexible if your business is in decline. And probably most importantly, if the deal is set up properly, it enables the company to obtain off-balance sheet treatment, which assists in its debt ratios. There have been recent challenges to trade receivables financing. Some banks have reduced their commitments from 2 years to 1 year. I'll defer to my my co-panelist, Hermes, on this next point. But there is a view that some trade credit insurers have become more selective, and there's been an increase in premia. Some banks are not taking the whole risk anymore. They're syndicating out to other banks and sharing that risk across them. And we've seen a move from securitization structures over to simpler traditional TRF structures. I've just put a very basic transaction diagram here to give you an idea of how these transactions work. In the white boxes, this is a traditional TRF structure. The yellow boxes show you what you need to do in very basic terms if you want to securitize. So we start with the company. The company issues its invoices, 60 to 90 day payment cycle, to its debtors. It wants to get financing against its receivables. It sells these receivables outright to a bank at a discount. They're always discounted facilities, and in exchange the bank gives back 90% of the face value. It could be more, it could be less, depending on how the deal's to be structured, but for this case, let's say 90% of the face value of the receivables. We've heard a lot about trade credit insurance this evening. Traditionally, there's a trade credit insurance policy in place. It's issued in favour of the company, but assigned to the bank, so that the bank, in the event of a dissolution event or an event of default, can step into the company's shoes and enforce. It's also not uncommon for companies to provide performance bonds or guarantees, but if, as a company, you're doing this transaction for off-balance sheet treatment, it's not advisable. From an accounting perspective, it's better to get a trade credit insurance policy. If you want to securitize, you take the bank out of the picture and set up an offshore SPV, a bankruptcy remote vehicle, which will then issue notes either to fixed income investments or to the same banks, but through their conduit programs. I've set out a list of principal documents. I won't go through them all because we're kept fairly limited on time, and I understand that the slides may be available on Doha Bank's website in any event. The receivables purchase agreement between the company and the bank or SPV is the most important agreement. That's the one that ensures that the receivables actually legally pass from the company to the bank. Moving on down, if the deal's syndicated, so there are more than one bank taking the funding risk, then you'll need to have some kind of funding arrangement in place. Legal opinions. It's very important to get legal opinions, and it's not just because law firms like to generate legal fees from them, but in these types of structures where there are some legal risks, you should be obtaining some comfort from local law firms. This slide sets out some essential representations, warranties and covenants that if you're a corporate, you should be expected to be asked for in your receivables purchase agreement, and if you're a bank, you should be expecting to ask them. They mainly relate to assignability of the receivables, that there's no existing security over them, no disputes going on with debtors. So really anything that would be an obstacle for you as a company to get those receivables off your balance sheet, and for you as a bank to be able to take them clean and free of any existing security. So moving on to legal issues in the UAE, I think the principal legal issue is that there is currently no law which deals with the assignment of rights, i.e. the assignment of rights to receive payment under receivables. UAE law does address the assignment of debts, but to date the assignment of rights is not covered. Well, what does that really mean? Well, if you're a company and you're trying to obtain accounting off-balance sheet treatment, it means you might have difficulty getting these receivables legally off your balance sheet. If you're a bank, you may have concerns about whether you have legal title to them after you've put the financing in. Even though there isn't any legislation, there have been a number of court cases in the UAE which have discussed the assignment of rights under these types and other types of transactions and notification and consent issues, most notably a Dubai Court of Cassation decision, which has given a great deal of comfort to the market. In terms of consent, it's generally understood that consent is not going to be an issue unless there is a restriction on assignment embedded into your underlying invoices. If you do have restrictions, then you're going to need to get consent from your debtors to enter into this kind of transaction. But otherwise, it's generally understood that you don't need to go in and seek consent. In terms of notification of your debtors isn't necessary at the outset, but from the bank's perspective, if they need to enforce, notification will need to be served on those debtors before enforcement's taken. There are issues on assignment of future receivables. If you've got a revolving facility, that might not be valid. And as Jody touched on earlier, there are issues on taking floating security over bank accounts. There are alternative structuring solutions. A trust structure can be set up. I know we're stretched for time, so I won't go into this, and it's more relevant in a non-civil jurisdiction. But alternatively, you can take a commercial decision to notify or obtain the consent of your larger customers. You can over-collateralize the lending arrangement much more. And in terms of the floating security issue, either set up a blocked account with the funding bank that only the funding bank has access to, or arrange for the collection account to be held outside the UAE and secured. Finally, I'd just like to touch on some issues that are specific to UAE public companies, because these issues aren't necessarily the same in other jurisdictions across the GCC or globally. There are sovereign immunity laws in the UAE. In Dubai, there's the law number 10 of 2005, which requires an approval process in order to enforce against a publicly owned company in Dubai. But the good news is that it is possible to obtain an approval and disapplication order from the ruler of Dubai, and this has happened on previous large securitizations such as the Doha securitization. There's no similar order outside of Dubai. The procedures law doesn't provide for a disapplication order, so you may need to consider that any waiver of immunity in your documentation may not be enforceable. Corporate guarantees. If you are obtaining a guarantee from a publicly owned company, it needs to be signed by the Director General of the Department of Finance and a member of the Supreme Fiscal Committee. If your client is a single shareholder decree company, be aware that it might not fall within the Commercial Companies Law, and it may require a decree by the ruler of Dubai in order to liquidate it if you hit problems with that client. And finally, and I won't go into details because Jody touched on this earlier, but there is still an issue regarding non-recognition of foreign laws and judgments in the UAE. So it's very prudent to take legal advice when you're negotiating your contractual documentation for these types of deals in the UAE. And that's all I had to say. I'm happy to take any questions.
Extremely well presented by Natalia Boyd from K&L Gates. She answered your question. I hope you have understood how much support local laws provide for receivable financing.
See, no, my question is, what is the in-country and the central bank regulation of Qatar in having the account opening for a Dubai-based company?
Dubai-based company, you should have a commercial registration again. You should have a local support, and you have to have incorporation in Qatar. That's the basic.
Because in Kuwait, they are allowing us to open a call deposit account, and we are able to, without opening a company in Kuwait, Kuwait and Jordan, we are able to open an account and, like call deposit account, and we can collect the post-dated checks, deposit there and transfer the money there.
Unless it is a government enterprise. You want to say something, Jody? Say it again, please. Here is a lawyer.
So you're talking about non-resident accounts?
Yes.
Yeah.
In Qatar, you need a commercial registration. Unless you have a government enterprise. I mean, we do have quite entities opening accounts government enterprises, because we know the transactions are routed through a central bank clearing account from Kuwait. We open an account for Kuwait investments or otherwise. So those are exceptions. As far as Qatar is concerned, you need a commercial registrations to open an account.
Okay, thank you.
Any other questions to Natalia? Ladies and gentlemen, it's a pleasure and privilege for me to listen to the Elite panel. I am sure you all have enjoyed as much as I did. I thank the Elite panel, Natalia Bonnet from KLL Gates, Rohan Westcott from Macquarie Bank, Philip Lemmers from PwC, Jody Waugh from Al Tamimi, and last but not least, Mahan Bochi from Euler Holmes. Thank you very much for your kind listening. Now we want to treat the visitors, the audience. We have a prize draw for the audience as well. Let him pick up 5. We have 5. So all the Elite audience will have the opportunity. You like to share? Please. Abu Yusuf. Bank of Tokyo, Mr. Lautfala Baustani. Is he here? Wow. Congratulations. Thank you very much for coming. Thank you. That's interesting. John Mathai, Managing Director, Coastal Light Footstep. Where is Mr. John Mathai? Is he here? He's going to miss the prize if he's not here. He's not eligible. You're right. Let's go for the next one. Again, the Consul General Qatar is here. This is way. Amin Shams, Finance and Administration Manager, TECA. Is he here? Here we go. Gentlemen, thank you for coming. Pleasure. ATCO, Isam Mugbal, Financial Controller Isam. There we go. Welcome. Pleasure. Let me have the pleasure of handing over. Thank you. See? The next one. Give it to him. Well done. Our Vice Chairman of the bank, since inception, he has been the founding member of the board. Tilda, Mr. T. Kolapan. Mr. Kolapan is here as well. Yes. Sorry. So we not only give the pen, this is the world's largest football miniature. This is. Doha Bank holds the record. Congratulations. Guinness record for world's largest football. One more. One more? Yes. Embassy of State of Qatar, Abu Dhabi, Mr. Abdul Rahman Muhammad Al Dahimi. Where is he? Definitely has not fixed it. This is a lucky draw. Congratulations. Thank you, gentlemen. Thank you for coming. Thank you.
ولا يسعنا في الختام سوى التوجه بالشكر لكم جميعا على حضوركم آمن أن تأتي هذه الجلسة بالنفع. At the end, we thank our distinguished guests for attending, and we hope you enjoy your dinner with us today. Thank you so much, and thank you to our panel.